Hello, my name is Tyler Wright, and this is my video essay final submission for Econ 325 Real Estate Economics. Getting started on question 1, the comparable sales analysis for the target location with 3 comps. I began by figuring out the average price per square foot for the 3 comparable properties, taking the selling price and dividing it by the square footage. And for that number, I came out with an average of $131 per square foot. And then taking that number, multiplying it by 1,500, which is the square footage of our target property, that came out to a estimated selling price of $196,500, which does fall right in the middle of the range of the selling price of the 3 comparable properties, which would indicate that that price that I came up with would be a fair asking price for properties of this square footage in the area. Moving on to number 2, we are in a real estate bubble currently, but the circumstances do differ from 2008. It differs in that instead of being driven by ninja loan-backed mortgages like it was in 2008, right now the bubble is being driven by historically low interest rates, and most recently artificial stimulation of the economy due to COVID through relief programs, stimulus, and so all of that has further pushed the bubble. It's also going to differ once it has a correction, in that I don't believe this bubble is going to result in such a devastating crash as it did in 2008, but rather a simple correction where interest rates rise, housing prices drop, and things stabilize, thus creating a good buying opportunity. Moving on to number 3, the approximate cost and length of time necessary to become a real estate agent. On the CE shop, it details that it requires 168 hours of pre-certification education, the licensing exam. You have to obtain errors and omissions insurance and submit your fingerprints and fill out the application. So that's really dependent on how quickly you can get all that stuff done. Now, as far as cost, the application is $485, the exam is $90, and it's only $90 given that you pass it the first time. The fingerprint submission costs $40, and the 168 hours of pre-certification education is $321. Now, all of that totals out to $936. But I do remember in Tanner's interview him saying that it costs about $1,000, and my understanding was that he was referring to just the pre-certification education. But that could have been a misunderstanding on my part, whereas he was actually referring to the totality of obtaining his real estate license, which would make sense because about $1,000 is what I came out to. Moving on to question number 4, the 3 geographic scales of analysis: location, 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 and that refers to market, neighborhood, and parcel. So for market, it's the first thing you're going to do when you're looking at investing in real estate is deciding what city or larger geographic location you're going to want to do further research in as far as investing into. An area that you believe is going to be profitable in the long run. Once you've decided what city or larger geographical area you want to invest in, then you're going to want to delve deeper into what neighborhood you're going to invest in. Now, for example, in Pueblo, it heavily depends on your investment strategy. If you're looking to simply flip houses, buy something cheap, do some work on it, and sell it quickly, you might want to be doing research into lower income areas with older houses that have not recently been renovated, possibly not quite as much amenities in the area, so that you can get in at a super low price, do your work on the property, and then flip it. Now, if you're looking for something longer term, something to live in for 2 or 3 years and then sell, or purchase and rent out for a number of years and keep it longer term, you generally want to go into more developing areas of a city. In Pueblo, for example, the north side, to where you can buy a property with the intention that more infrastructure is going to be built in that area in the near future, and that's going to drive up the value of your property, all the while you're collecting rent, waiting to sell. Now, once you have your neighborhood picked out that's oriented around your investment strategy, you're going to need to pick out what parcel, actually picking out the lot with the property, the building on it that you want. And this is where you're going to do comparable sales analysis to figure out what properties in the area are fairly priced, what properties you think you can get a deal on, finding an underpriced property and then trying to negotiate even lower. And yeah, you'll just have to find a property that fits your investment strategy. So moving on to question number 5, the analysis of the fourplex determining gross rent multiplier and cap rate. The process of finding the gross rent multiplier is as follows. You determine how much you're going to charge for rent per unit in your multi-unit property. You're going to take that to get your monthly gross rent, multiply by 12 to get your annual gross rent. And once you have your gross rent and your asking price, you divide the asking price by your annual gross rent, and that gives you your gross rent multiplier. I did it all by hand first before realizing it was already detailed in the document that the gross rent multiplier is 17.7, which is an incredibly high gross rent multiplier, which would indicate that either you need to charge more for rent or negotiate down to a lower asking price. Now for cap rate is simply net operating income divided by asking price. Finding the net operating income can be sort of a guessing game and a little difficult to find, but luckily in this document it was given to us. If it wasn't, net operating income is gross annual rent minus the vacancy rate and minus total operating expenses. So a lot of that you're going to have to estimate if you don't already own the property, because you don't know exactly what total operating expenses are going to be as far as repairs. But once you have net operating income and asking price, divide net operating income by asking price. And in this example, that was 34,324 divided by 850,000, giving a cap rate of 4%, which is just slightly below the ideal range, which again would indicate that either the asking price needs to be negotiated to a lower price, or there needs to be a way figured out to increase net operating income for that particular property. And finally, number 6, the advantages and disadvantages of investing in real estate over stocks and bonds. Start off with advantages. Advantages is that the profit of real estate investment is more in control of the investor. There's a lot more that the investor can actively do on a day-to-day basis to determine how much profit they're going to make, as opposed to just sitting and waiting to see what the market does in stocks and bonds. Real estate is typically far less volatile than the stock market. So if you're looking to invest short-term or long-term, it's a little bit of a safer investment if you know what you're doing and you know where you're putting your money. Another advantage is you can negotiate for a lower buying price in real estate. When it comes to stocks and bonds, the market price is the price you buy it at, period. Whereas you can do a comparable sales analysis to find a property that's appropriately valued and then negotiate to a lower price so that you buy it at an undervalued price. And then finally, you can get practical and financial use out of your asset before selling it. Whereas stocks and bonds, you purchase it and it just sits there and you hope that it increases in value. Whereas when you have property, you buy it with the intention of it increasing in value to sell eventually, but during that time you can rent it out, charge rent, you can live in it yourself. So you can get benefits out of it while you're waiting to sell it. Now, some disadvantages of real estate investment is that it's a lot more hands-on and time-consuming than stocks and bonds, where you just sit back and wait. You have to actually go out, you have to talk to people. If you're renting it out, you have to do repairs, you have to be a landlord, you have to collect rent, you have to evict people. So it's a lot more time-consuming. Another disadvantage is that your asset, while you possess it, is at risk of destruction due to natural disaster, whether it be fires, tornadoes, earthquakes. And that's another thing that would go into your research for your market, the first location, in location, is finding an area that's not super susceptible to natural disasters, because that's a real threat with real estate. And finally, real estate does require a lot more research and education before you purchase. With stocks and bonds, you can kind of look up a few blog posts and get a general understanding of what companies are projected to be doing good, and just buy a bunch of stuff in small increments and hope for the best. But when you're purchasing a property, that's a lot of money all at once, and it's a lot more involved, so you're going to need to do your research in order not to get burned. So yeah, in my opinion, a lot more advantages than disadvantages, but that is just my opinion. So that concludes my video essay final for real estate economics. Thanks.